We've all heard that 99% of startups fail. But here at Founders Genie, we are going to change that entire paradigm. We are determined to make every founder successful every day by solving their real life problems in real time. So entrepreneurship is hard. Being an investor over the last 10 years, I have seen the journeys of real life entrepreneurs very closely and seen their hardships. They have a lot on their shoulders to deliver on with very little access to resources. So what is the concept here at Founders Genie? Being an entrepreneur myself, I know that to solve a lot of the problems that I face on a day-to-day basis, I need an entire ecosystem that is capable to solve any problem and is trusted. And if you add a layer of technology on it, then we should be able to solve these problems at a speed and scale that has never been done before. So what are we trying to do here and how? So at Founders Genie, we are building a multi-layer tech platform on top of a peer-to-peer network. What will this allow you to do? This will allow you to source the right talent for your open positions. It should allow you to talk to the relevant mentors and experts who can guide you to the right direction. You will have access to the smart capital providers here. And of course, you should be able to reach the right customers who are not only willing to buy your products or test your services, but also be willing to try out the MVP that you have. And last but not the least, you should be able to get a compatible co-founder for yourself right here.
Good afternoon, everyone. Thanks for joining us today. Founders Genie is based on the mastermind concept, which was formally introduced by Napoleon Hill in his book, Law of Success, defining as the sum total of minds of two or more people who work in perfect harmony for the attainment of a definite purpose. A mastermind peer-to-peer mentoring group is used to help members solve their problems with input and advice from like-minded founders. And that is exactly what we look to provide entrepreneurs to make their journey less lonely. The mastermind concept can help you accomplish in 1 year more than you could accomplish without it in a lifetime, if you're dependent entirely on your own effort for success. While we have read about it, we have had the good fortune of experiencing it through our platform. Founders Genie is built on 3 pillars of high quality, quick solution, and cost effectiveness. Its primary objective is to find solutions to any given real-life problem. You can hire pre-referred talent, look for mentors, explore synergies, find industry specialists or experts, and yet be free of spam messages. Founders Genie provides you access to solutions at your fingertips via our app. To join, request you to scan the QR code at the bottom left of the screen, which will take you to our website. Please fill in the form and we will get in touch with you. We are happy to provide you free membership till November 2021. Also, if you are an experienced industry professional who is looking to help and guide startups, we will be putting a link to register as a mentor. Request you to complete the registration as a mentor and we will get back to you if there's a fit. Now I would request Harsh from Founders Genie team to give you a demo of our app and walk us through different features. Over to you, Harsh.
Thank you, Kanak. I'll just share my screen. I hope my screen is visible and I'm perfectly audible.
Yes.
A very good afternoon to everyone present on the call. Before I begin, I would just like to request all of you to keep updating your Founders Genie app as we keep on introducing new features and improvements. Today, I'll be walking you through discussion forum. So the first screen that comes up on your phone when you log into the Founders Genie app is the discussion forum. This is the place where all the magic happens. Let's say you're facing any challenge in your company and you feel the need for an external help or info. So you can post that query on discussion forum by clicking on post a query button here. Just select the relevant forum in case you have multi-forum access. Describe your query select the relevant tags. And in case you want to attach any file with your query, you can do that as well by clicking on the attachments button. Once done, you can just click on this green tick button and your query will be displayed on discussion forum. This query will now be posted and will be visible to all the members who will then help you out solve this query with their rich experience and knowledge. In case you come across any query that falls into your forte, we really encourage you to help the peer network by answering it. That's it for today's demo. Back to you, Kana.
Thanks, Ash. Starting with a masterclass on what investors want by speaker Mr. Tushar Kansal. Thanks, Tushar, for joining us today. Tushar is an accomplished professional with experience spanning multiple sectors from venture capital, Big Four consulting, LSE listed System India unit to CFO of Boganam Partners' own company. He is mentor and judge at entrepreneurship cells of IIT Bombay, Delhi, Chennai, ISM Dhanbad, and such marquee institutions. Tushar has expertise of financial and business advisory, fundraising, and creation of docs collateral for VC funding. Over the years, Tushar has arranged funding for startups and growth stage companies in diverse sectors like EdTech, FinTech, consumer, B2C, B2B, AgriTech, etc. His expertise opinion is often sought by leading business news channels and publications like CNN, News 18, VCTV, Business World, etc. Tushar has received his executive education from Harvard Business School, and we welcome Tushar here. Tushar, over to you.
Thank you for giving my introduction, and I am looking forward to a nice presentation and discussion on this crucial topic, what investors want. So I would like to start by giving a presentation and which will cover a lot of aspects of what investors want. Just to introduce this topic, the industrialist, the corporate professional, the wannabe startup founder, the old economy, the new economy, the tech sector, the non-tech sector, everybody wants to become an investor because they are seeing the kind of value and wealth by startup founders and by investors throughout the world. The background to this is that quantitative easing, which means printing of money, it's going fast since 2008-9, and that is because so that economies don't go into a depression, recession, and hence those monies are chasing asset classes right from stock markets to stock market related activities, and one of the subset of seeking returns is startup funding. Because if you invest in a fixed deposit in a foreign currency, you hardly get anything. If you are depositing in yen, the Japanese currency, you will probably have to pay the bank to keep your money. And it is only in India that we hear of interest rates of 12%, 14%, and 10%. Although on the FD side, post-tax interest rate is still quite low at 4.5%, 5%. So money is chasing asset classes. A thing like cryptocurrency, which is just a number on the screen, it has no practical value. That goes till trillions of dollars worth of total bitcoins, and that's the age we live in. Now, to start the presentation, first of all, the investor doesn't have time, and to save time, he looks at getting a crisp lowdown on whatever you are offering. And one of the things which the investor likes is a small 15-slide pitch deck. So a pitch deck is a presentation which gives the information presented properly and all the information which he wants. So I will also cover on what all information the investor wants.
Tushar.
Oh, sorry. Yeah, sure. now?
Yes, yes, it is.
Okay, thank you. First of all, I would give a lot of importance to the pitch deck. A pitch deck is a 15-slide document, as I just discussed. Now, the importance of a pitch deck. The importance of a pitch deck is it is the first impression you are creating on the investor, and uh, having a quality pitch deck makes a lot of difference because the investor will see your pitch deck and then probably want to talk to you. And if he has seen a document which he doesn't really feel comfortable with, then your chances of getting investment goes down. What all information does the investor want? The investor wants a problem statement, solution. I'm just running through, then I will take them one by one. The team behind, market size, the product. This is very important because a lot of startups are into technology and product platforms. Business model, traction, which means what is the business you are currently doing. Competitor analysis, competitive advantages, financial projections, funding ask. This is very important. If you ask a startup founder what is the money he wants to raise, he will feel very, very constrained to say that he needs 20 lakhs or 30 lakhs. Probably everybody wants to raise minimum 3 crore, 5 crore, 10 crores. And I won't blame them for it. There are two reasons for it. One is that they see the numbers in the news and media, unicorns growing by 4 or 5 every week. And the second part is that their dreams are big. They don't want to keep on running after investment rounds, and they feel that we should raise sufficient money right now itself. Many a times there is a gray area in the funds they are seeking because what they have already created on the ground does not match with what they are seeking. We will discuss more about that as well. Use of fund, very important, future roadmap. And so first, most important is problem statement. Now, you might be creating a manufacturing company, or you might be creating a service company, or you might be creating a technology or a non-technology company. But end of the day, what is the impact you want to create? Impact in terms of reaching out to lives of customers who are your end beneficiaries and from whose wallet your revenue will come. What is the fundamental problem in their lives which you are solving? I remember I actually at one point in time had a consumer startup, and I had visited Matrix Partners office in Bombay to seek funding for my startup. And my startup was in hair extensions, which is a human hair product, and it is used widely by people of African origin. And while at Matrix Partners office, Arpit Agarwal I met, and he said, Tushar, do something which impacts the lives of people like Uber and Ola have done. And you are no longer looking at rickety taxis and taxi stands, searching for taxi stands. And that is the impact which Ola and Uber have made, and Uber has made specifically worldwide. And we kept on discussing about it. And that day I realized that your problem statement has to be very neat. You have to identify the problems faced by customers, and if you don't have a solution to it, you don't. People like me, they have a habit of spending hours behind something, even if it is taking too much of our time, and we better do something which can be solved. So we have to think of a problem which is short and straight. And one of the things which I remember clearly in the companies which are getting funded recently is that they found a big problem and they found an easy solution. I'll give you an example. Sugar is a big problem with health problem with a lot of Indians, because in our food, we eat a lot of sweets. and our food is made more of wheat and maida and stuff. So naturally, our sugar levels are high, and there are companies which I see which are promoting less sugar foods and fast foods, and that is something which I love when I see that kind of a problem being solved, because a diabetic doesn't have access to a lot of foods, and if he is able to have a sugar-free chocolate, as an example, that is a big problem being solved, and it will have takers throughout the world, not only in India. So that is the kind of problem and solution. Uh, your solution can be very simple, but end of the day, there has to be a business which has to be built around the solution. And it is very easy to say, I will provide uh, groceries at Pan India on the click of a app like Big Basket and Grofers. But it is a hyper local play. It is a cash intensive play. It requires tons of dollars. And more important, it requires operationally heavy business. So, your solution, it has to be very constructive. You have to think it through, that what you are trying to create, and you have to take cognizance of all the practical difficulties which might come in while you are creating such a kind of business. And I see a lot of companies which are into artificial intelligence, machine learning, and I feel that using that kind of a technology is a very practical way of solving a lot of cost related issues which come in while we are dealing with a customer database and marketing. So, uh, so that is the solution part. The team behind is the most important. If you talk to VCs, venture capitalists, if you get some beer time with them or coffee time with them, they will tell you we see founder first and we see product second. Founder is what we put money on, whether it is early stage or late stage. And a lot of investors say that if we are investing early stage, then naturally there is nothing much on the ground. There is hardly any MVP, minimum viable product. There is hardly any PMF, product market fit. So naturally we are investing more on the founder. But it is true across startups that they like to put money in hustlers, in people who break the norms, who create new norms, who fight governments to make a change by the innovation they are bringing in. So governments, they are not able to keep up pace with the change in technology. So these people create such stuff that the laws change. And team is most important. I'll tell you an example. I'm dealing with a aviation company. 2018 pass out from aviation engineering in Moscow. This guy, uh, just in the first meeting, he will create what he wants. So he wanted to meet the aviation minister. There was some goof up. Somebody promised. It didn't happen. He just went into the constituency of the aviation minister, met the party head there, and in 2 days he got his meeting. So these are people who are hustlers, who never look at. They don't like to hear no, and they don't like to hear negative stuff. So if a sector in India is $50 billion, they always say, why can't we grow in this sector if this sector is $50 billion? That is the moot question. And each problem can look as a big problem, but end of the day, it is the sum of parts, and any problem can be solved with time. One very important part here in the team is the roles. So, if you have a technology company and both the founders are non-technology, definitely, it will create problems. So it's better to have a tech person, a balanced team, have a finance person who will take care of your costs, have a product person, have a marketing person, and I'm not saying have all of them as founders, but have them in the team. And and roles should be distinct yet complementary. Now, market size and opportunity. There was a pharma SaaS company which I was working with, and we went to. Oh, by chance, it is another example of Matrix Partners. We had gone to Matrix office in Delhi in Aerocity, and we had a 1.5 hour discussion. The discussion was very positive, and end of the day, there were some numbers which the founders were saying in front of the Matrix team. And the guy there, he reverse calculated the numbers which the founders were saying in terms of businesses which are being done across East India, South India, North India, and West India. And they back calculated as to what is the competitor, how much percentage they are holding market share in the sector, and they back calculated the size of the sector. And the total addressable size of the sector came out to be small, because then the deal didn't happen, because the fund said that they like a minimum total addressable market TAM size of $5 billion. And that is the importance of market size and opportunity. If you are a B2C company, India is a huge consumer market, and definitely you will get the numbers. You might get more numbers in terms of number of customers. Monetizing might be difficult, because in India, it's a very price conscious market. It is a market which takes a good time in taking buying decisions. But end of the day, the market size is what matters a lot. So, if you are a B2B company, you can, of course, access new markets. So once you create a PMF in India, product market fit, you can plug and play your business across geographies. And a PMF achieved in India is valued a lot, because we are a tough consumer, price sensitive market. Then the business model. This is very important. The investors, they like to see how are you making your money, and end of the day, what is your marketing going to do in terms of forming structures, whether it is a commission based model, it's a monthly or yearly subscription, it's a direct sales, wholesales, distributorship, and this is very important. Some what they do is they show the product to the investor. They say, sir, you have a feel of our product. If you feel as a customer, you have a buy-in for the product, you like the product, then we can easily come back to you and tell you how we are going to make it a success. And showing the product, I think it's a very impactful way of creating an impression in front of the investor. A lot of people nowadays are making 5-minute or 3-minute video pitch decks. They create an impression definitely if they are wisely made. If it is shabbily made and 3 people just talking, and then it will work the reverse, because video always creates more impact in the mind. Then next, traction. So if you have a traction, heft in asking for a good valuation. So I've seen people who who say that, sir, we need a 10 crore valuation, we need a 20 crore valuation. One of the pharma companies I was consulting, when they met me earlier, initially, they were straight away asking for 100 crore, 80 crore to 100 crore valuation. So, the thing is that if your turnover is very less, then how will you support your valuation? So, the valuation can be through future cash flows, which we do. But end of the day, if you have business on the ground, that is the proof which investor sees. So, we were doing a deal, chocolate confectionery manufacturing company, and having own brands. You're talking to Rabo Equity, which is the #1 food fund in India. the Rabo guys actually went to the a distributor sitting far. They spoke to him that dhanda kaisa hai, that what is the situation on the ground? How does the product take off? What is the working capital? Uh, how much, how do they manage logistics? Issues about quality, because a distributor would know everything. And that also a distributor who's not sitting in the city, but in the suburb. So, I hear of other funds also who do actually have people who go to the city of the founder and find out about the background. They find out also about the ground business as to what is the genuineness of the turnover which the founders are claiming. So this is a very important metric. I see a lot of idea stage and pre-revenue deals. I would just recommend them go and have a MVP, minimum viable product. Construct your MVP, possibly, if possible, do your PMF, get some revenue coming in, 50 lakhs, 40 lakhs. It's just a turnover. So it's not like profit, right? Initial stages, we are just putting in money. Just have that, and then support from the investor. And traction can be stated in revenue growth, customer growth, and partners growth. So, these are some of the examples. Now, competitor analysis. One of the fintech companies which has recently won a license from RBI for prepaid instruments. They are my clients. And, they have very good board of directors, people from RBI, the chairman of SBI, and they have raised $1.63 million from a Taiwanese investor. And I was talking to them. We were talking to one of the big investors in the market, Rajul Garg of Leo Capital. Rajul was, as usual, very straight, cut to the point. And Rajul was trying to understand what is the prepaid instrument they're trying to create. So we have debit cards in the market. We have credit cards. Sorry, not credits are not prepaid, but we have wallets and we have other instruments. And it depends on your positioning as to what customer segment you are trying to catch. And Rajul asked them, who is your nearest competitor? And they were able to shell out 3 or 4 foreign names in the US and in UK and Europe. And Rajul was immediately able to understand what are they trying to create, because they not only told the name of the competitor, but they also said, how are we different from these competitors? And that created a big impact, because suddenly he could see the business. The investor could see the business. So, so you should be knowing who are your closest competitors across geographies, not only in the country in which you are doing business, but across geographies. If you have a very good idea, and it will add to your ask from the investor, because if a product has done well in US, in the foreign markets, then it is likely to do well in other countries also. Not as a general rule, but mostly. So you can present your competitors' names in your pitch deck properly as well. Then competitive advantages. If you are giving the name of your give the advantages which your company has over the competitors, because you are not there to sing the praise of competitors only. And along with the competitive advantages, you also have to say that I am doing this business better than my competitor, and this is what I will achieve in the next 5 years in terms of revenue, in terms of operating profitability, which is EBITDA, and in terms of customer growth and maybe product sales, as an example. So giving these two things side by side will help your case a lot. Now, I consider this very important. A lot of people don't have any idea that what is the amount of funds they should ask for. And I consider this as a big challenge, especially in the Indian market, because Indian startup guy is actually India is a big reading market. We read a lot and look at newspaper sales, look at magazine sales, look at the online viewership on the media sites and the TV viewership. Especially on news, we are very heavy. And so what happens is that the amount we are asking usually if you go by the valuations, you are able to ask a good amount from the investor. But if you are just pre-revenue and there is nothing much on the ground, then it is just like throwing darts in the dark. So it's like there is no. So you should clearly know what is the amount you are asking, and what how much percentage you are offering to the investor. And I have seen founders who say, I am asking 5 crore and I'm offering 16% of the company, take it or leave it. So a lot of investors, they like this attitude. They like it because there is so much ambiguity in valuation whenever it comes to valuation. So they like it because they say, okay, fine, I like the business, 16%, make it 18% or 20%, but 5 crore I'm giving, let's do the deal. So they like this clarity. So, so you should put the ask, very clearly, and use of funds. Now, I was sitting with a very good fund, and one of the clients was sitting with me, and we were talking about the use of funds. And my client said, 48% of your funds, which I'm asking for, I will use in marketing. And what happened was the investor didn't say much, and we kept on talking. After some time, the conversation became very informal, and we were talking more like three people sitting from Delhi and, like in a bar or pub or something. And he said that, I don't like your use of funds. He said 48% in a consumer business for marketing is too less. We want 92%, 92%. Because we want market growth. We want you to emerge a leader in the market before anybody else does. And that is the kind of money we put, and that is the use of that money which we want. So, use of funds is very important. You might take it for team building. You might take it for product development. A lot of tech companies which come, they say that we will take it for product development. You might want to, there are 2-3 things. Some founders say that they would like money for working capital. Now, this is a challenge. A lot of investors say, why should we give money for working capital? If you want something for working capital, you take a loan. But the problem is that a lot of banks, as per the RBI rules, they hardly give working capital to a startup without taking collateral like a real estate, hypothecating, taking charge of real estate or some other asset. So that becomes sometimes a problem, and definitely equity has to be used for working capital, but some investors don't like it. And secondly, some founders, they already have a debt on their heads, and they say that we want to raise equity because we will retire some of this debt. And that is also something which a lot of investors don't like. They say that whatever salary which you will be taking, and that in the earlier rounds which the companies get, the salaries are fixed. The investor does not want you to take huge salaries. So he says that whatever personal debts you have or corporate debts, you retire them later. Use my money for growth and expansion. This is the motto of the investor. Then future roadmap. Again, use of funds is one thing, but what will you achieve by having these funds? And that is what the investor likes to see. So your roadmap can be, we will launch in 5 states. We want to reach 1 million installs on the product, or we want to get the intellectual property done by the end of first year, and stuff like that. And these are again, very, very important things for the investor. This is a sample roadmap. It can be like platform launch, teacher introduction. This is a education technology company, and content production, expansion, and user acquisition. So this is the presentation. It is short and sweet because I thought that I should keep it open more for the discussion and the questions and answers. And one thing I want to tell to everyone, because there is so much of media around venture capital, around angel investment, around equity, around stock markets, around valuations, around rich people, wealthy people, that if someone else created a successful business in 5 to 10 years, you can also do it. But again, don't forget the fact that the other person did it in 5 to 10 years. You can't jump and create something. End of the day, your product will require improvements every day. Uh, and you will have to team quality teams, take care of them. You have to keep a focus on the changing nature of the market. You have to follow the best practices which are there in the market, and it requires a lot of patience. And so, if you want to be in the startup founder game, be in it for a long term. Jack Ma and Jeff Bezos, they have put their entire life into it, and they are amongst the very few who achieve the top status. But behind every top status guy, there are hundreds who they didn't reach the top, but they actually made a lot of money, and their companies are still doing well, and they found a niche for their product. And that also must have taken equal amount of effort as compared to Jeff Bezos and Jack Ma. And so, the field is wide open. The GDP growth is still there. The sectors are still booming. Stock markets are supporting valuations, and a lot of money is chasing asset classes. Everybody is an investor. Even a housewife of a rich family is also an investor. And the money is out there for the taking. Just find you. So just stay focused. So this is what I wanted to cover today. Thank you. Thank you, everyone. And I would like to take questions which Divyansh or the team at Inflection and Founders can come through. Thank you so much.
Thank you, Tushar. Uh, Starting with the question, so we have one question from Mahendra. For how many years one should show the financial estimates? Any guidance here?
5 years. If you put it for 3 years, it is too less. I'll give you, okay. Before saying this, I should actually tell you something. When a fund guy raises money, so he raises money from limited partners. And if he raises money from European companies like pension funds or family offices, and European families are very old industrialists, they give you money for a very long time. They won't ask you to return it before 7, 8 years. If you are taking it from a mid company or a investor, he might give it to you for 5 years. And if you are taking it from an Indian industrialist family, they will want to take their money out after 3 years. This is just a ballpark figures. They are not rule of thumbs. These are actually rule of thumbs. So, a small formula. So when you are creating a financial projection, 7 year, 8 years, nobody is looking at. 3 years is too short, because first 1 or 2 years you will be making losses because you will be investing the money. So, third year till third year comes, your EBITDA would not be that good, and your profitability would be very low. So 5 year is actually a very good time um, to give financial projections for. 5 years.
Sure. And so we have a question from Chitran Srivastava. How to identify your competitive advantage?
Your competitive advantage, let me take an example. Twitter versus Facebook versus Quora versus Instagram, YouTube. Why is Twitter still surviving? It is in losses. It is a mid kind of product. It is neither to the YouTube and Facebook kind of multimedia level, neither it is on a small media company level. It is in between, and still it is valued at $50 billion, and Facebook is $800 billion, and Google is beyond $1 trillion, but Twitter is still surviving with $50 billion. Now, what are its competitive advantages? People are nowadays mentally very tired of over reading of data. So the small limit. Secondly, how do you reach out to people whose voice matters in the world, who create rules, who create examples for others, the leadership across sectors? Twitter gives you an easy solution. Just tweet to them. Probably their team will be managing, and if your tweet reaches, so you will get answers. So Twitter, what other competitive advantages it has? It can offer you hashtags. It can offer you putting your multimedia with a very small character limit. And all these advantages it has created over time, and it could not solve the advertising puzzle. That how will it take care of advertising? So they worked on it, and they again were able to reduce losses by a huge amount. So some competitive advantage already exists, and you have to make it better and side by side solve your other problems, which definitely somebody or the other will find solutions for.
Sure. So we have one from Mr. Shubham. How to calculate pre-revenue valuation?
Pre-revenue valuation. It's actually, what do I tell you? There was a company which came to me from Bangalore. They were into bringing all these marriage halls and banquet halls online. And the founders were very nice. And when they started off, they found an investor. So the investor said, you are just starting off, so let us keep your company valuation at 1 crore. Let me give you 36 lakh rupees and take 36%. They said, okay, fine. There is nothing on the ground. They did that. Now, in Delhi, in Chanakyapuri, there is a company started by a real estate guy. This guy used to work for a builder. Now, he said that weddings.in 12 crore turnover got sold for 400 crores. So I will start a new weddings.in. And the builder said, yeah, it is 400 crores and 12 crore turnover. You start this company, and the valuation, the first valuation is 10 crores. And gave him, lot of money for that, 15%, 1.5 crores. Now, two exactly same companies without revenue, one valued at 1 crore, one valued at 10 crores. So my bad answer to this can be, which you all will find non-scientific, that it depends on which angel investor you catch. So there is no basis to create a valuation. So my team can do valuation for non-zero revenue companies by discounted cash flow. So we will make 5-year projections. We will see what are the incoming cash flows in the 5 years, then calculate their present value. And that is the value of the company. But the investor will say, no, these 5-year projections should not be like this. It could be different. You will not be able to achieve. Your costs are not properly calculated. So it becomes a vegetable buying game. So my advice to you is that talk to, just find a right angel investor who can offer you support in the business also. And if the investor knows the sector, probably he will give you a good valuation.
Got it. And a very interesting incident shared by you. So we have more questions around valuation. So one is valuation vis-a-vis current turnover. Is there any particular formula for deriving the same? And another is how with current turnover of few lakhs, companies are valued about few crores. How can that be possible?
So the
Is it
turnover
based on
is
projected?
yeah. So there are two questions. One is that how is revenue multiple, valuation linked to revenue, and 2 lakh company valued at 2 crores. See, revenue, the nature of turnover and the nature of revenue is you just sell something, it becomes your revenue. End of the day, that revenue does not have much meaning if it is not recurring, if it is not coming back again and again to your balance sheet. The main thing which matters is operating profit, EBITDA, earning before interest, taxation, depreciation, and amortization. The main thing is that, because that shows how well you are making your money, how good your business model is. So now you said, what is the link between revenue and valuation? Usually, I used to work for Deloitte and Touche, and we had very, very long discussions on all these things. And I will tell you that actually the ratio which is seen by investors is the price, the profit multiple, the valuation divided by profit, and EV by EBITDA, enterprise value by operating profit. But today's times, see, if angel investor is investing 20 lakhs, he will not keep a 5 lakh company for the valuation. So you have to just talk it out, and then you say that in pharma tech companies, if you look at the recent deals which happened, we call it transaction multiples. If you look at recent deals which happened, they happened at 10 times revenue. So naturally, you can quote that in front of the investor. You can say that this deal happened at 10 times revenue. And if you look at education technology, Byju's and all, they are happening at 100 times revenue. So an education technology company can tell the investor, sir, this happened at 100 times revenue. So a lot of the data of Byju's or any other so revenue is usually quoted in media. The valuation is quoted in media. So you are able to get a multiple. But from an investor's perspective, what matters is the valuation divided by EBITDA. That operating profit multiple was what? That is what actually matters. Now you said 2 lakh revenue and 2 crore valuation. Let me take you again, give you the example of weddings.in. 12 crore turnover, 400 crore valuation, it got sold. Now, in a banquet hall kind of business, you know that marriages are very costly in India. If one marriage we assume is of crore valuation will be supported by 48 weddings. Or if you think 25 lakhs is too much for banquet hall, you can reduce it to any figure, 10 lakhs. So we are talking about 120 weddings. Now, weddings.com team, how much effort it would have done for getting 120 weddings done and earning the 12 crore. I'm talking about revenue. Hardly anything. You have a team, manages, a season is going on, you are booking banquet halls left, right, and center, and you are making your margins. And in 1 year, you did 120 weddings. And it got sold for 400 crores. I mean, that's like why a lot of founders, they believe in jackpots is because look at Kunal Shah's free charge. Got sold for, I think, $300 or $400 million to Snapdeal. And later on, Snapdeal sold it to $30 or $40 million to Axis Bank. So because these valuations are crazy, I mean, Tesla $900 billion valuation, more than the total of all other automakers. Doesn't make sense. So, on the 2 lakhs to 2 crore thing, how does the investor think? He thinks 2 lakh, practically there is no revenue. 2 lakh is nothing. So is zero revenue. Now, if I take too much equity, then the founder will get demotivated with time. So how much should I take? See, anything above 26%, the investor gets right on the board of directors to block special resolutions of the board. So, the founder will think that he's taking a control of the board. So the investor thinks, okay, I have to take less than 25%. Let me take 16, 18, 22, 24. And this guy saying he needs 2 crores. Okay, fine. I'm giving 2 crores. So this is the way decision happens. It is not a formula that 2 lakh, got a 2 crore valuation. So it's quite actually fungible kind of thing.
Very well explained. So we have a question from Mr. Mohit Kumar. How do we calculate TAM?
So there are 3-4 ratios for calculating the market size. And market size can be calculated in top-down or bottom-up style. The top-down style is that you have some numbers in the public domain, and out of that, for example, Facebook might claim that it has 2 billion users, but what matters is daily active users, DAU, and those are the active users on the portal every day. And so if you divide the total revenue of Facebook, which is around $70 billion, with the total active users, you get an idea about what each active user is paying. So if you take that figure, that this is what active user is paying, and I am likely to have 1 million active users and they will pay this much, so you will get an idea of the market. So this is how it is the top-down approach. And bottom-up approach is what is the total, a lot of these numbers are available on the company website, government website. So you pay 100 rupees, you can get financial data of any company, even if it is a private company or unlisted company. So you take out the top 5 competitors, the top 5 in any market, and you know that they are holding 50% of the market. You just sum all the revenue of these 5 companies. You have an idea about the market, what 50% market is. Then you double it, you get a total market share. So all these are ways to calculate these ratios.
So for attendees, Tushar is also available on Founders Genie as a mentor. Because we have 24 open questions, we might not be able to take all of them. Also request Tushar to keep it short so that we can answer as many as possible.
Sure.
So Tushar, next question is from Mr. Afzal. If startup is fortunate to have multiple investors interested, how to score or choose the right one? What are the ways to look at investors?
I didn't get you. If a startup is
fortunate to have multiple investors interested, how to choose the right investor?
It's a very good question. How to choose the right investor? Now, you might have an investor who will, who will be not from the sector background, and this person is, because he does not understand the sector, he will actually take a lot of your time to understand what you are doing. Where is the money going? Why was this money spent like this? And if you have a guy who understands the sector, he will know the figures, like 10% goes there, 20% is the usual market number for salaries. And then, there is industrial house investor, and then there is the CXO kind of investor, maybe a dollar investor, who's working in a big company in Singapore, Hong Kong, and so on. So how to see the right type of investor? I would ideally tell you, take it with a pinch of salt. Somebody who believes in your vision, somebody who has seen a similar type of companies being created in his experience, and he knows that it can be done, and who has the patience to be with you and support you. And I know many such investors who support the companies a lot, support founders a lot. And those are the investors you should have. And of course, you should have a relationship going there. If you don't have a relationship going there, you will find that you are getting into a problem. And because the board of directors, this guy might have a seat, and strategically they might think that no, at this time we don't want to expand because it requires money. The investor does not want to put in fresh money, and you might be thinking that this is a time to actually go from 5 crore to 50 crore. So there is an example of a company. This company is into, I can't take its name because when I met them, they told all this to me over a beer. So I can't take its name. So they are into defense technology and non-defense also. And the technology which they have created is actually quite good. And the founder got his investment because the founder father was in BSF, very senior, border security force. And he actually stayed at the Indo-Pakistan border for 6 months to understand the difficulties faced by the soldiers and how he can use technology to solve those problems. So when this person met one of the very good funds in India in Gurgaon office, he met the fund at an event. They immediately went into a long discussion, and within 1 week they had the term sheet. But one of the clauses which the fund guy said was that you cannot operate out of Indian market. You have to operate in the Indian market. And although the technology of the company was became a mill around their neck, gale ka fanda ban gayi. So they could not go beyond India. And since they had perfected the technology in India, and India's defense is very choosy about buying which weapons they want to buy, they keep on testing it for years and years. So in spite of having that kind of a validation from the Indian defense, he just could not go outside India. So he had to actually plan to raise funding from future investors with a view to also pay back the previous investor and get him out of the cap table. This is not an ideal situation to be in, but I'm telling you the practical difficulty in having the wrong clauses with the investor. And so these things, they matter a lot. When it comes to angel investment, try and get a founder who understands your business, and probably who has some follow-on money also to, in future rounds, he can lead the round. Because if the angel investor is leading the round, you have a hard commitment from him, term sheet or a email. Email is a soft commitment. Then naturally, because you have a lead in the round, your round will close faster. So you have to, there is this company, this guy is a technology guy, been in the US since many years, and now in India since many years. And he is a good technology guy. He really understands technology very well. So he met an industrialist. The industrialist said that, okay, you want to make a stock market gamification site. I will put in the money. But how will you solve it? There are so many problems. So this guy actually gave the solution, the technology solution on each of the problems. And now that investor is such a good investor, he keeps on putting money in the company. So you have to see all these things.
Yeah. So I think we are running out of time, but there's this interesting question, I think, which will be helpful to all other attendees also. How do we build network with VC or PEs? So we can take it in a way that how to reach out to investors.
First of all, you get your Google presence nice. You should be writing blogs on medium.com. You should have videos on YouTube. Your website should be very nice. You should have written some, so whenever somebody searches your name on Google, the first 10 or 20 results should tell a good amount to that person. Because anybody who meets you and after that, they will do a small check. And the check is usually through Google. And passionate people, they write a lot, they create stuff, they create data, they talk a lot about what they believe in, and that's what shows. And how to reach out is the best way is through the founders of their investee companies. If the founder of an investee company rings up the fund guy and tells him, I want you to meet this guy, he will take him very seriously. And you will get a heads up. So because you are reaching through the right person. The second way is through LinkedIn. Again, it's like cold calling. So when you are sending a ad request to the person, send a personalized invite. Write a paragraph that I want to interact with you. And but that's the last solution. Always try and meet through someone. But if that is not possible, then LinkedIn is the solution.
Got it. So I think there are a lot of open questions. So what I will request is the founders can send their questions and connect with Divyansh. We can help you connect with Tushar. He is a mentor with us. Tushar, any ending notes you would like to end on?
I want to, okay, I am accessible on LinkedIn and LinkedIn Tushar Kansal, and my surname you can see on the screen, Kansal. My company name is Kansaltancy Ventures. And don't feel shy in approaching me. Maybe I can help you in many ways, maybe on the documentation side, or I don't know, by funding side, VC funding side, or maybe like mentoring and giving you the right solutions. And on what investors want, don't think it is a science. It is more of you going out, trying something, hustling it out, and you will definitely reach the right person. So, and one has to put trust actually end of the day in people. So just keep your faith alive. And my all the best to all of you, and happy to reach out to you and talk to all of you. Thank you. Thank you to Divyansh, to Harsh, to everyone in the team who, Konark, Pratiksha. Thank you so much.
Thank you, Tushar. Thank you for this insightful session. Thank you everyone for joining us.
Thank you, everyone. Thank you, Tushar.
Thank you.
Members
Thank you,
can join in Founders Genie and have a complimentary membership till September 2021. You can use a QR code on left side of your screen at bottom. Also, Harsh from Founders Genie shared a link on the chat box. And for all the session update and previous session recording, you can join our LinkedIn page to get view of those sessions. We'll just keep it open for next few minutes, then we'll close the meeting. Thanks, Tushar, for your time.
Thank you, Divyansh. Thank you, Kunal. You have a very professional team. It's just amazing to be on your talk every time. Thank you so much.
Pleasure having you.
Thank you, Tushar.
Thank you.
I would like to inform all the attendees. The links for joining Founders Genie for both founders and mentors are in the chat window.